All right, everyone. We are live. Welcome to the stream. It's DeFi Friday. Good to have you guys here. We're excited to have the show as always. My name is Alfred from Diversified Capital. Thanks for joining us, Raymond. Raymond, how are you doing?
Doing good. How's your day going?
Good. It's another Friday. It's sunny outside, right? I'm
Indeed.
probably going to get outside in a little bit. We've got a special guest joining us. It's been a little bit for Nathan. Nathan, founder of our company, is going to be joining us today because the market was a bit crazy. And you know what? It's a little too much to handle for Raymond and ourselves. So we're going to have Nathan join us in just a little bit to talk about the market. But today's show is going to be about part of what's causing mortgage rate increases. And we've gotten a lot of questions lately about what's driving that and also how that affects somebody when they're thinking about their mortgages and refinancing. So we're going to give you some quick tips there later in the show. We're probably going to spend a little bit more time today talking about the market, just given how crazy things have been. But again, as we're talking about these things for DeFi Friday, just remember that these shows are more for just education, right? General education. It's not meant for personal financial advice. We have a place for that, diversifiedcapital.com. Check out our new video on the Get Started tab and learn a bit more about what we're doing, how we're approaching financial planning, and just a little bit different than the rest of the industry. Okay. As we talk about investing, right, we're not soliciting you to be buying any specific product. It's again just so that you guys can be asking the right questions, thinking about your portfolio a little bit differently. Okay. And not meant for specific investing advice. Anything we talk about tax related, focus that to your tax professional. Okay. We're just going to be talking about that general side there. All right. Done with the disclosures. Always takes me a
Yeah.
little bit to get through it, but no, it's been a wild week, right? I mean, I think the good thing to review here today is from Nathan. What are some of his thoughts? How's he implementing some of his different strategies and just thinking about the market broader? Because it has been about a year, right, since we've seen a little bit of an adjustment. So I want to hear from Nathan to see what his thoughts are. So I'm going to bring him on right now. There he is.
Hello.
Man of the
How's
hour.
it going, guys?
Hey, Nate.
Yeah. I haven't seen you in about 5 minutes. Sounds good, right? It's good to have you on, man. It's always good to have you on the show. How have you been?
Good to be back. Good. It's been crazy couple weeks in the market, obviously.
Yeah.
So happy to be here to kind of chat through that.
Yeah. And we're going to go through some things. I've got some questions for you that, people have asked me of. And so we're going to run that by you. But, I think it started out a little bit when, people had this, which is why we're talking about interest rates, because there was a jump in interest rates and kind of triggered off a set of events, right? And so before we get into, Raymond's got already some market data to show us, right? So I'm going to put that at the bottom there. And what are you seeing first with the numbers, Ray?
Yeah. So another week where NASDAQ got hammered.
Yeah.
Luckily, we saw a rebound in today, primarily due to some payroll that we've seen from reports that we've seen, and also falling unemployment rates, which helped
Mm-hmm.
with the rebound that we saw today. But overall, S&P 500 for this past week is up 80 basis points.
Mm-hmm.
Dow Jones actually up almost 2%, and NASDAQ is actually down 2%. So quite a difference there between NASDAQ and the other S&P 500 and Dow Jones.
That's right. And the data that I had shown just a second ago was, of course, last week's data, right? And you'll see it scrolling again on the bottom. This is of this week. So still actually, as crazy as it was, ended the week positive 2 out of the 3 indices. But I think the NASDAQ one is the most interesting one. So what are you seeing, Nathan, in why NASDAQ is getting hit a little bit harder right now? And then just a general overview of what's causing that.
Yeah, NASDAQ last year was up 45% last year.
Mm-hmm.
So some of it's a reversion to the mean. You don't generally see a 45% NASDAQ and a 7% Dow Jones type of investment return. That sort of dispersion between the indices is massive. So some of that is reversion to the mean. But the real concern right now that all investors have, and you guys have touched on it, it's inflation, right? We've printed 40% of our GDP in money to help us through the coronavirus situation. We've got another $2 trillion stimulus bill on the way. People are concerned that inflation is going to get away from us. But people say, okay, well, we've got the Fed on our side, the accommodation of the Federal Reserve with Jay Powell. Janet Yellen, we've got, two doves in place that's going to help this easy money train continue. The bond market's telling us something the exact opposite. The bond market does not believe that Jay Powell and the Fed have control of the inflation factor. It's being seen in the rapid rise in rates. We ended 2020 under 1% on the 10-year Treasury. Last week, we got as high as 1.61, fell to 1.4 by the end of Friday. This week, we ended up higher yet again. And so it's not necessarily that 1.55% on the 10-year Treasury is concerning in itself. It's the rapid rise of interest rates that is concerning. Is this 1.55 current reading going to become 2, going to become 3? If that's true, then we need to rethink the prices that we're willing to pay for these growth stocks. A lot of these growth stocks, sure, we've got Apple and Facebook and Google with great balance sheets, but for the most part, a lot of these growth stocks still lean on debt to grow their company faster and faster and faster. If debt becomes more expensive, will they still be able to meet those growth expectations? That's what investors are very nervous about. If the E on the price to earnings multiple comes down, no one wants to pay this, same price for something that is growing less fast. And that's exactly what's happening. The market is repricing what they want to invest in and what is out of favor. People are taking profits in names that have been up 100, 200, 1,000% in the case of Tesla last year, and saying, you know what, we've had a great run. I don't know that this easy money supply is going to continue. I want to be in something that's a little bit safer, something that has a 10 price to earnings multiple, that pays me a dividend, that has cash. That's going to be part of this reopening trade. And so that's why you're seeing the opposite of what we saw in 2020. It's now growth is being sold, values being bought. And it's huge rotation that we've seen in really the last 3 weeks.
Yeah. I mean, it's healthy though, right? In a way. Like, I think it honestly makes me more uncomfortable when the markets just go on a tear straight up from March, right? Like, no looking back. Every day you look at the market was green. Okay. And I think that in itself, generates bubble talk, right? And then, of course, as markets come down, it generates correction talk. Like, no one's happy, it seems like, when right on headlines. Why? Because they want you to read it, right? They want you to read why it's case. But in our eyes, it's a healthy situation when you have these corrections because things can't go up forever. Maybe over time, asset prices increase, but in the short run, there has to be a breather. There has to be some realization that, right, certain IPOs that went up insane valuations, Tesla, for example, you mentioned, back down into the 5 with the number in front of it. I mean, still is something where you say, all right, at least it's reasonable. At least people are looking at data now again. And it certainly makes me and us, I think, as a team, feel that, markets aren't just like completely kind of engaged from what's really going on, which is, again, driven from numbers, driven from data, driven from earnings. Those things still have to be real, right? And so,
historically speaking, stocks are a great way to combat inflation. I mean, I think people are still in favor of stocks. They're just rebalancing what type of stocks that they like. Today was a really interesting market too. I mean, just talking about Friday specifically, it's very possible that we got that capitulation moment today. You noted that Friday was an up day. We finished, the market was green today. Were you up at 8 o'clock in the morning? It was very, very, very red, right? Tons of names down double digits this morning. And so I think it's possible. I'm not trying to predict a bottom, but it felt like everyone just gave up on growth. It's like, forget growth. I'm just going to sell what I can and I give up. That's generally a capitulation moment where people, have finally given up. The rest of the selling is kind of worked through and we find that bottom, and possibly that's why we ended up today in the positive. But when you continue to see positive economic data, I think it's still going to the point of people being concerned about inflation and the inability of the Fed to possibly control that.
Yeah.
They keep saying that inflation might be temporary. We hope that's the case. But they keep saying we're not going to raise rates for 2-3 years, basically. There's no expectation for rate increases this year. If inflation, which is 1.4% right now, all of a sudden is 3%, I don't know that the Fed's going to have an option but to raise rates to keep inflation down. That's the concern. And those fears have not gone away. They just get reinforced when we see continued improvements in the labor markets.
Yeah, and as things open back up, right, people are going out to spend money, pushes potential just consumer goods up in prices. I don't think we've quite seen that yet from the money printing, right? So that money gets introduced back into the hands of businesses and merchants, and that could continue to push prices to the upside where we could see more inflation, right? But I think it's interesting to note, right? To your point, it's like these changes in the market, right? Like sharing with you guys, the viewers, like what do we talk to our clients about when these things happen? It's not to sell, right? It's to evaluate and say, number one, if things that you liked before, right, are now down 15, 20, maybe some even 30, 40% from a February high, and you were thinking about it in February, why wouldn't you buy it now? Right? If I'm watching a iPad and it's 40% off right now, I'm gonna go buy that iPad, right? And so if think about it from a stock perspective, it's the same way. The stock market perspective, it's the same way, as long as you still like the stock. And to Nate's point, I think what you're seeing is maybe generally people are saying, I had a great gain in Peloton, or I had a great gain in Zoom, whatever the stock was that was in favor. Maybe I like something different right now, but I did so well, so I'm going to rebalance. And so people are going to think a lot more closely about what stocks they want to buy. And so, and back to the point of evaluating whether or not it makes sense for someone to keep paying these prices, especially if they rely heavily on debt and interest rates are going up, right? That's exactly, I think, what's going on in the growth market, where maybe in the S&P and the Dow Jones, you're not seeing quite the same, because last year they didn't see quite the same upside either, right? It wasn't as crazy of gains in multiple, right? And so I think you put that all together, the line below makes sense. Also, why, what is it now? I think off the top of, for NASDAQ, they're like 11 or 12% off of its highs.
It's just under 10 after today's positive bounce. So, I mean, 10% sell-off is pretty normal, especially for something that's more growth heavy like the NASDAQ. Look at the Dow Jones and the S&P, they're off 3 and 5% respectively.
Yeah.
So this is, I think people are just maybe going through some PTSD because of what we experienced this time last year with 35% sell-offs. But to me, I think this is just a natural rotation, and we're just getting new leadership. I don't think, it's very rare for you to see a recovering economy and yet the stock market completely fall apart. So I'm not, too bearish on the stock market right now. I think it's just a rebalancing going on.
Side note, you see a 35% drop in the market in NASDAQ right now, you'd still be positive had you stayed invested from last year, right?
True.
It's crazy to think about, but it's true about long-term investing, right? You would still be positive in that case, given that 44%, 45% rise, right? All right. So, I mean, I think, to summarize, right, you have a changing and worrying part about inflation and rates, right? It's causing what people are thinking about their growth stocks relative to the what they're paying for, right? Is it worth it to pay for that stock? And you're seeing an adjustment right now where, again, Dow leading the way at the moment, making a comeback. So for you guys watching, you should go back into your accounts and say, where am I invested in the US? Do I have just something that's a all-inclusive total market, right? Or is it something that I have some S&P, some value stocks, some growth stocks? If that's the case, guess what? We talk to our clients about the importance of understanding the different pieces that you have, understanding that growth can outperform one year by quite a bit or down quite a bit, right? So those are the important things to keep efficient returns in your account. Okay. All right. Leads into our second piece, right? And so I'm actually going to keep Nate on for just a little bit to get his approach on as he talked about mortgage. But when we're talking about increase in rates, we've in many shows now and in a couple of our recent shows talking about real estate, the impact of rates, like impact of how as rates go up or down, what does it mean to purchasing power? So we'll talk about that in just a little bit, just to again reiterate that. But the focus today is more so, hey Alfred, hey Ray, hey Nate, rates gone up, should I still refi? Right? Like that's the question that we're getting. Or this idea about if there is an opportunity to refi, my lender is coming back to me and saying, I need to pay $10K to refi to get some rate. Why should I do that? What does it mean? Okay. And so that's what we're going to go through right now, and talk about a couple of things. What is a buy down? What is a point? Okay. And then talk about, like, is it worth it to do so? And then we'll give you a summary of some of the things to think about before you do a refi. Okay. So while we have you here, Nate, like, when we're seeing, right, some of the rate increases that we've seen over the past week or two, what are you seeing clients say to you in terms of, like, are they holding off on buying because rates have changed? Do they feel like it's still low? Just give us anecdotally what you're hearing.
Yeah, and I think just to set the record straight, people look at the Fed's actions and they say, "Oh, the Fed's not going to raise rates, so why are mortgage rates increasing?"
Mm.
So again, it's tied to the 10-year Treasury. The 10-year Treasury is basically investors saying, "I think inflation's going up, therefore I require a higher rate of interest to purchase this 10-year Treasury." That's what is then causing the mortgage market to then see increased rates. That doesn't set all the action, so just want to set the record straight there. But still, even a return to 3.25%, something in that range, yeah, it's higher than 2.5 that we saw earlier this year, last year. Um, it's still historically very low. Like, I still have people moving forward with purchases. I still have
Mhm.
people, excited. They're still getting below 4%. So I don't think the recent uptick has stopped people from buying. Um, my hope is that maybe it stops some people from buying, so some of us can actually, win a bid. That's been really frustrating. But I don't think anyone's, stopping their purchasing. People are still moving forward with purchases. As far as refinancing goes, it just depends on where you were, right? If you didn't refinance in 2020 and you were still above 4, yeah, of course it makes sense. Unless you have to pay, like what you said, those points. But I'll let you guys tackle that. But so far, people are still moving forward with real estate purchasing on my end.
Yeah. And if you look at, and again, not all of you watch it on video, some of you listen on audio, look
Mhm.
up the historical 30-year fixed rate data for 1 second, right? I mean, the downtrend of that line and where we are still, in my mind, near bottom. And I had a client ask me, like, oh, I don't want to lock in rates. I want to see it go back to 2.5. I'm like, are you sure it's going to go back to 2.5? Because I'm not sure it's going to go back to 2.5, right? Like, with what's happening with these inflation worries, if you think it's not quite just a market fluctuation. It's not just a stock going up and down, right? It's the ideas that we just spent the first 15 minutes talking about why rates are going up. I don't know that those fears or beliefs are going to change anytime soon. And if you're in contract to buy a house and you want that to change in 30 days to go back, right, to where it was before, I think that's a hard gamble, right? I think it's a really hard gamble to have. And you look back at some of the rates back in 2018, 4.7, for you to say that you might be getting a 3.1% rate, that's still so good that you just have to put things in perspective, right? And I think that's a key point here, just making sure that you're understanding that while 2.5, 2.6, 2.7 was probably the lowest that I've ever seen, it doesn't mean isn't relative to history still a very, very low rate right now, right? So you got to keep that in mind. Nathan, I know you're going to have to go soon here. Thank you for joining us, right? I,
Of course.
always enjoy our conversations offline about investing, and I'm glad that our viewers get to hear a little bit from you about your thoughts, and we hope to have you again on here soon. Yeah?
Thanks for having me. Have a good
Thank
weekend.
All right.
you.
Bye, Nate. Finally got to get rid of him. No, I'm just kidding. I think it's time to talk a little bit about points and the buy downs and what that means. I think we hear a lot of confusion around that. Okay. And so when someone says there's closing costs, right? I think the first thing that we ask is, how does that closing cost break down, right? Is it certain fees you're paying the lender, right? Or what is it? So give me, Raymond, what you see when you see a client tell you, I have 6K in closing costs. The lender is asking me to pay things up front. How do you explain a buy down or point to them?
Yeah. So, I mean, first things, I mean, even with a closing cost, right, when you're looking at it, it can be $10,000, but we generally recommend to at least get like a loan estimate or some kind of final estimate that they can break down really where those costs are going. And from that closing cost that you see, a lot of times, I would say about half of it, right, just depending on your property taxes, like insurance that you are going to have to pay for, those are things that you would have paid for in the future. So I tend not to count that as part of the total closing costs. Yes, you're paying it now, but those are things that you're going to have to pay eventually anyway. The other portion of it is going to be like appraisal fees, going to be escrow fees, it's going to be other fees that they charge for processing this refinance. So part of those fees too, if you had wanted to buy down, and buying down meaning, let's say the current rates today are 3%, right? But you're looking for maybe a 2.75%. So that's buying down to 2.75%. There's going to be a cost to it. So they, for example, say it's going to cost 1 point. That 1 point is going to be 1% of the value of the loan that you're trying to refinance. So if you multiply those two numbers, that's basically the amount that you're going to pay to buy it down to 2.75%. And then in terms of other costs to it, that's generally, where we get questions from our clients is, how much should we buy down, right? So the further that we buy down from our current rates, the more and more expensive that it's going to get. So that's something that we always want to reevaluate to see, is it worth putting down that much money down right now just to refinance to a lower rate?
Yeah. And so if you think about, right, the upfront costs, the next question that we normally get would be like, is it worth it? Right? Like, is it worth it? So Nate said, hey, if you didn't refinance yet, it's still probably a good time to look at refinancing because of where rates are. Completely true, right? Once you get into the refinancing piece, right, then what are we looking at? Well, again, I'm just going to share with you guys a little bit, right? And if you guys are listening to audio, we're not affiliated to bankrate.com in any way. I am just a huge fan of how their website works for me to evaluate something on my own, right? And similar to different sites that we always talk about, and we're not shy from talking about them in terms of how they can help you, things like NerdWallet and whatnot, right? Bankrate.com has been really helpful for people to just see how rates would be, whether it's a refinance, are they doing something like a cash out option? So again, not an ad in any way. We're not affiliated to them. If they want to reach out to me for an ad, let me know. No, I'm just kidding. Right? You want to see just the idea here of what the upfront costs are, right? So, if a lender tells you that it's $6,300 in costs, well, how much of that is discount points or buy down, or how much of that is an underwriting fee, or to Raymond's point, how much of that is just me prepaying things that I normally would have needed to pay anyway, right? I wouldn't count that. Now, in the case, the discount points, there's some level of break-even point, right? My costs that I pay up front, when do I make that up, right? And so how do you look at that, Ray? Like, what's like a way to understand the break-even, and then maybe what's a good time frame that someone should hopefully be breaking even before they consider if points make sense or not?
Yeah, so generally, if you're offered, different options with different points that you have to pay with the interest rates, we try to evaluate just what the difference is in monthly that you're going to be paying, right? If you have a lower interest rate, hence that's going to also provide a lower monthly payment. So we like to look at it as the difference between the monthly payments and the different rates, and dividing that with the difference in the points that you're paying, right?
Mm-hmm.
So if you divide those two numbers there, generally we're trying to look for somewhere between 2 to 3 years, right? So about 24, 36 months, maybe 48 months would be pushing it. But a lot of times, when you're actually running that number yourself, you might see something more towards the 8 or 9 or 10 years mark where it might not be worth it, right? So really trying to find out that time, the amount of time that it takes for you that you're saving from the monthly payment to make up for the extra points that you're paying for that lower interest rates.
Yeah. And again, it could be the monthly payment, right? If you really want to get detailed, it could be the interest portion of every payment, right, that you're actually saving. But I think this is an interesting example, right? Like a situation where maybe you're paying, zero point 0.7 points up front for a loan. That might be $750,000, 750K. We're talking about 5K up front. And then they kind of go through, at least if you check on bankrate.com or some other sites, it'll tell you what's your total cost over 5 years, right? Inclusive of the points. Well, a separate option that they give you is, well, you could pay 1.8 points upfront, which is again more than double the points, and then check the 5-year costs. And you know, in simple terms here, the 5-year cost of you paying more points here is still more expensive than the 5-year cost of the one you pay less points, even though the interest rate is 2.75 and more expensive. So you'd be like, all right, I paid some points, it's at 2.75. It's not quite at 2.5%. But if I'm just evaluating the interest rate, I'm saying, yes, I'm getting a lower rate at 2.5. But if I'm only again staying in the home for 5 years, does it make sense? Did I actually benefit by paying those points up front? So we're always thinking about that, which is like, yeah, how long are you going to stay in the home? Or in other words, it could also be, how long are you keeping the loan? Because who knows? I mean, I personally have been in my house for 4 or 5 years. I thought I got a great rate in the beginning. I think I've refinanced like 3 times already, right? And so had I paid points up front for another loan, it's just a little hard to stomach if the market rates again drop back down. I don't know if they're going to be dropping to this level, as we talked about. I think it'd be very difficult for that to be the case. But you have to evaluate, which is like, when am I going to break even? How long am I going to stay in the home for? And is it worth it for me to keep this loan, right, for a long time for me to actually see the benefit of the buy down, right? But what's another part to it, right? Which is, if I'm paying 15K or if I'm paying 6K up front, what else am I losing on, Ray, when I do that?
Yeah, so one of the things that we like to take consideration is going to be time value of money, right? The opportunity costs of putting the extra $8,000-9,000 that we're putting up front that could have been used somewhere else, right? And that could be used towards investing within the market. It could use to be other short-term goals that you might have. But if we were to really compare it, and if we did have those funds, that 9K to invest in the market, like what would be an average return that we can expect from that, right? And that would actually be a negative cost to us because we're putting more upfront payment down for that. So that's also something that we want to take consideration. Generally, if you have a lower interest rates, that also has a lower monthly payment too. So there's 2 different calculations. Like one is the higher upfront cost that you're putting down, where we could be, earning maybe 5 or 6% on it, and then we're also paying a lower monthly payment, right? So that's also a positive to your opportunity cost, because that way that allows you to make up some of the money because you're not paying that full amount monthly, right, with that lower interest rates.
Yeah.
So
And I think a lot of people miss that. And in fact, I think it's hard to visualize sometimes opportunity costs. Look, we throw around that word all the time, right? Like you take a finance class, you do any of that, you're like, you got to account for your opportunity costs. But it's real, right? I mean, the best way to think about it would be, right, if the bank is giving you a loan at 3% rate, it means that you don't need to come up with the money. Even if I assume that you have the money, like if I assume that you have the money for the mortgage, you take out the loan, you're choosing not to put the money into the loan. Same thing for points. You're choosing whether or not you should put the money into buying down the rate. If it's a 3% or such a low rate right now, what are you earning on your $15,000 or $100,000 that you could have put into the loan? Because if that was something that is earning 10, 11, 12%, aren't you using the bank's money to make money? Isn't that the power of real estate, is to be able to leverage at just these rates? And I'll tell you the answer is yes, right? Right? Everything tells us that within reason, right? Within, as long as your finances are good and you're not overly aggressive in borrowing too much money, when rates are low, you should borrow money so that you can utilize that to do other things with. And that's exactly what Raymond is saying, is that once you account for the points difference, you have to say, yes, but I am putting in $15,000, right? And that $15,000 could do other things for me. So when you apply to all of that situation, you have to then be careful to say, sometimes points do make sense. The break even might be 1 or 2 years. And you're like, that's very aggressive. That's really good pricing for me to buy down rates. But if it's longer than that, then you might have to ask, how long am I actually going to keep this loan for? Or in general, this house for, right? I think our team was saying that the average time to own a home has gone from, I think, 7 to 5 years. It's gone down, right? And so if you no longer own the home, the mortgage doesn't matter, right? It goes away with it. You can't carry it on to your next home, right? So bottom line here is this, right? With the rates coming up, you want to think of a couple of things. One, relatively speaking, they're all still extremely low right now. Okay. Historically, that they're still at low, right? And so, do you want to be playing the game where next week it jumps up even more, right? When you can lock in a rate or just close out and say, I'm happy with what I have. Okay. The second thing that you want to think about is making sure, right, you understand the money that you put into buying down points. What is your break even, right? Is it worth it? Am I in the home long enough for that to make sense, right? And then from there, understand what else would you be doing with that money rather than buying it down. Am I fully invested, right? Am I able to earn a better return on that? Because if you are, you might be able to utilize that opportunity cost to your advantage. Okay. All right. Raymond, great topic. Anything else to add to it before I close out here?
No, I think we covered a lot on it. I mean, it's things that are changing from what Nathan mentioned
Yep.
and what we're talking about. It's been a rapid change, right? So I think it's a fair question
Exactly.
that people have in their mind. I mean, even just as an example, client that we spoke to about a month ago in terms of a strategy, that probably has completely changed now in
Yeah,
terms of how quickly it has risen. So
for
every
sure.
situation is different. So hopefully with the knowledge that we provide today, it gives you a sense of where to start and what to think about when considering the refinance, and making a good decision from that point on.
Asking the right questions, right? We're always hoping that you guys get that information from us to start asking questions about your own finances. Again, thank you again for joining us. As you guys know, right? We're always live here every Friday at 3, looking to bring more topics, more content to you guys, and enjoy the way that we're able to share these experiences with you, and broaden the financial education space. Okay. If you guys like the video, subscribe to the channel, give us a like, give us a comment. Thank you again so much. Thank you, Raymond, for having us. Happy Friday.
Thanks, Alfred. Have a great weekend.
Bye.
Talk to you later.